Welcome to the Energy Show. I'm journalist Markham Hislop, and the working title for today's show is Trump Unleashes Chaos on the American Economy. My guest today is Ed Hurst, a University of Houston economist and frequent media commentator on the U.S. economy. So, welcome back to the show, Ed.
Thank you, Markham.
I don't even know how to introduce or describe what U.S. President Donald Trump is currently doing to the American economy. As a journalist, I subscribe to all sorts of newsletters from various organizations and research, think tanks, that kind of thing. Everybody is just lighting their hair on fire.
Yes.
Why, Ed? How bad is it down? You're in the eye of the storm down there. So give us a sense of what's going on.
I think it's a great example was last week when the U.S. Trade Representative was being interviewed in Congress. He was talking about the tariffs, and suddenly, at the moment he was being interviewed by Congress, um, Trump abandoned the tariffs, and so the argument that the congressmen or senators are asking him, well, did the president just pull the rug out from under you? And the poor guy looked so perplexed. And obviously he had. Well, he went into the hearing with the best information he had about 20 minutes ago. And then during the hearing, federal policy, U.S. policy changed.
Okay, I had an economist on it, about a month and a half ago, and he said the even worse than tariffs is uncertainty because
Ah,
that spooks investors. And are we seeing a capital flight out of the U.S. as a consequence of that uncertainty?
oh, absolutely so. But the capital flight is another issue also. So if we raise the tariffs, that means the U.S. is going to actually import less. That means fewer U.S. dollars are going to go abroad, which means that those nations receiving the dollars who can't use them in their own currency are going to stop with their investing back into the U.S. markets. And so as this circular flow of capital diminishes, we can see foreign investors, foreign to the United States, withdraw money from the U.S. capital system from stocks and bonds. Also, another leg of the Trump policy and the Project 2025 policy is a devaluation of the dollar. And I think global markets need to be well aware that this is one of the initiatives that the Trump administration is going to follow through with at some point in the near future.
For us non-economists, and I assume that that's probably most of the audience, and it's certainly me, explain what it means that the U.S. greenback is the reserve currency of the world. How important is that, and what happens if it stops being that?
Well, the reserve currency. It's one that by convention, the global economies have agreed is tradable. We can trade it back and forth. I mean, we have seen attempts, for example, to sell oil in euros. That really didn't last very long. But the dollar has been living outside the United States. There's more currency abroad than there is in circulation in the United States. A lot of this came from the Cold War, and the Soviet Union, in order to purchase goods and services from other nations, needed to build up a store of dollars. And so the euro dollar was born out of that in the late 50s and early 60s. Um, Nations trade dollars and their own currencies back and forth. And so it's a the global marker, if you will. The British pound used to have that sort of cachet prior to World War II.
So what happens if it, because I'm hearing some talk about how China would like its currency to become a replacement for the greenback. What happens if that happens?
Well, I don't think it's going to happen. The Chinese government tries to work a peg on its currency, and it's non-tradable. The United States has essentially a free flow of capital, a free flow of investment back and forth across its borders without any taxes on this movement. China restricts the use and value of its currency, and so it's not a safe place to go. Anytime an autocrat in Beijing can change the value of your holdings, that's more risk to somebody who's the holder. And of course, the United States has devalued its currency as the reserve currency very successfully in 1985 as a result of the Plaza Accord. This was during the Reagan administration. The US dollar had become extraordinarily strong against other currencies. And so the G7 made the agreement to directly, explicitly sell down the value of the dollar. This reduced the purchasing power of the dollar. And things moved back into an alignment where U.S. exports became more competitive with other nations' goods and services. It really doesn't change the standard of living within the United States, since most of what U.S. citizens can buy is denominated in dollars, but it results in a great realignment across the global economic system.
Ed, there's a story floating around Canada, and many of us are trying to confirm it, and we haven't yet. But here's what the story goes, that Canada holds about $350 billion of the $9 trillion US debt in Treasury bonds. And Mark Carney, who is the Liberal leader and also the Prime Minister, and also a central banker who knows this system as well as anybody, went to Europe, went to Japan, made a deal with some of the other countries, and basically then went back to Donald Trump and said, if you keep threatening tariffs, we're going to sell our bonds and we're going to tank the US dollar. So back off, and it was about that time that the threats to annex Canada, make it the 51st state, put economic pressure on, suddenly he stopped talking about it. And I think that's given that story a lot of currency, if you will. Is that a plausible scenario that Carney could have done that?
Well, it certainly seems plausible from where we're sitting right now, but it was no question the vulnerability to the bond market last week was illustrated, and suddenly Trump changed his tune. Um, the U.S. debt is no longer the top-rated debt facility in the global market. We were downgraded some years ago, but still, it's the safest debt on the global market. It is the safe haven, and the U.S. has really enjoyed that over the last 60, 70 years.
Well, let's talk about markets because we saw a crazy week last week for the stock market.
Right.
And what's going on there? If you could just sum it up for us.
Well, there's a huge amount of uncertainty. The layoffs across the economy and the reduced federal spending is really hitting a lot of high income individuals, reducing the money going out from the National Institutes of Health, the reductions in grants to universities, institutions, the scrambling around for foundation money to replace that. For example, NOAA, the National Oceanic Atmospheric Administration, has pulled back funding for carbon monitoring in the atmosphere, and so the Keeling curve, Ralph Keeling, is looking to shore up those efforts with private contributions now. The damage that's being done is really ramping up the uncertainty. We saw violent swings in the Dow Jones and the S&P 500 last week. This is terrifying, not only seniors across the United States, but an awful large number of Trump's base, because they count on this increased value of the stock market to fund their retirements. The market was up a couple 100%, since well during the Biden administration, and Trump has begun to reverse that in his first 9, 10 weeks.
Is that a deliberate policy to reduce the stock market? And if so, why?
He's making it sound like it's a deliberate policy, like he stated. Well, there's going to be some pain, but it's really hard to say because he really is not holding to one course or another. It changes from hour to hour.
Speaking of, let's talk about oil for a minute because that was a big topic here too. A couple of months ago, I had you on, and we talked about the Canadian oil being exported to the U.S. It's about 4 million barrels a day, and most of it is ultra heavy sour crude, which gets used in the Midwest and some in the U.S. Gulf Coast down in Houston, where you are. And but this is kind of crazy. So on the one hand, Trump slapped 10% tariffs on, and I don't even know if they're still on anymore. There's a whole lot of confusion about what is being tariffed and isn't. Um, but he said we don't need your oil. But then on the other hand, trying to drive oil prices down, and they have gone down. I'm looking at them now, and West Texas Intermediate is $61.50. Western Canadian Select, which is the heavy, is 48.70. And we're in this crazy that West WTI price is basically the break even for shale. And Trump says he wants it 20% lower, which would end drilling in the Permian Basin and other shale basins. So he doesn't want Canadian heavy crude, and he's basically putting the brakes on drilling in the U.S. industry, which is the opposite of what he promised during the campaign. How do we make sense of that?
Well, he's certainly making friends with members of OPEC Plus, and that would include Saudi Arabia, Kuwait, and Russia. I mean, he's playing right to their strength, if you will, or what they would like to see happen. Uh, as we know, West Texas is not a substitute for Canadian crude. One strategy Canada has is to call his bluff and say, "Well, you don't need our crude. Fine, we'll stop selling it to you." And that would explode the myth of U.S. energy independence because, for the refineries that operate on the Canadian crude, the U.S. would have to turn very, very quickly to the heavy crude from Saudi Arabia, the very heavy crude from Venezuela, if they have any to spare. Um, that would, of course, cost us some significant amount of money. The 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 playbook, though, is complicated. OPEC Plus has announced that next month they're going to increase production by some 411,000 barrels per day.
Right.
Uh, it's nice that they can be so precise. The IEA this morning came out with a report that forecast diminished growth of about that much going forward, and if for the year. So if we just kind of look at the price elasticity of demand for crude oil in the global market, it's for the wonky minus 0.047, meaning that for a 1% decrease in the supply of oil to the global market, you would see about a 20 to 25% price increase. And of course, the flip side is the same. If we add 1% to the global market, the price will go down 20 to 25%. It looks like we've got about a 0.5% roughly coming online. So from $61 a barrel right now, we could see West Texas drop to below 55 pretty easily by the end of next month.
Another wrinkle to this, Ed, is that if the WTI break even is around 61 to $63, as I was reading today, that's not true for the Alberta oil sands producers. Many of them, it's a very different form of production for any of the viewers who aren't aware. The shale is kind of it's not, I wouldn't say it's conventional, it's unconventional, but they have to drill new wells every 18 to 24 months because of the steep decline curves. But in Canada, those oil sands, it's like a manufacturing facility. You have a reserve in your bitumen, and you set up a plant to extract it, And once the capital is paid off for that plant, your operating costs are very low. And so the break even for many of those producers is $20 a barrel, $30 a barrel, maybe on the high side, $40 a barrel. And they can withstand low prices for a long time. So, in fact, it may turn out that Donald Trump needs Canadian oil a lot because his domestic producers can't produce, can't break even at the price he wants oil to be.
Right. And so we saw with the Dallas Fed Energy Survey at the end of 2024 that probably only 15% of US producers would consider drilling new wells with a price lower than $70 a barrel. So we're going to see rigs laid down in the Permian Basin, and they are rapidly. Last week, I think, had the fastest, highest rate of decline that Baker Hughes has seen in some time. Yeah, the Denver-Julesburg Basin is now running half the rigs that it ran this time last year. And so as we look at it, the cessation of new drilling in West Texas is going to lead to a pretty rapid decline in the production. If we start, say, at about 4 million barrels a day, it's very conceivable that 6 months from now will be 10% less, just if the drilling of new wells and the completion of the new wells ceases. And so, that additional 400,000 barrels a day that OPEC Plus is bringing to market may very well drive 400,000 barrels a day out of the West Texas production in 6 months.
Eddie, it's the Wild West out there. It's I guess nobody knows what is going on from day to day. And buckle up, Buttercup. I don't. Any advice for folks who are watching and trying to make sense of all of this?
Yes, and so the first thing is if one has U.S. assets, protect against a declining U.S. dollar, because if they cut the value of the dollar by half, you're not going to be in any good shakes with this at all. Number two, if one has a bunch of oil assets, I would also think about hedging down, making sure that you've layered in some long puts. Um, yeah, this is going to be the case at least for the next several weeks going forward. Don't know what it's going to look like over the rest of the 4-year term. Congress is very skittish right now. The Republican congressmen and Republican senators are getting an earful as they go home for the Easter break. Obviously Trump's not listening to them. There are no governors holding back the president in this administration.
Well, Ed, thank you very much. I'm sure we'll have you back on in the near future because we need somebody to make sense of what's going on south of the border. Thank you very much.
You're welcome.
Thanks for watching the show. We are on a mission to reach 10,000 subscribers and over 1 million views. If you're enjoying the content, give us a thumbs up, share your thoughts in the comments, and subscribe to our channel. Thanks for being part of our community.